Certainly, Chairman Powell seems to think so. His 180 degrees turn that we saw at the last Fed meeting was interesting. Maybe it's because he knows he's out of the job pretty soon. He's getting more honest. But if you look at the actual reason why we have this change is, Jeff, that the physical world is simply too small, or put in a different way, the real economy is now biting the financial markets. I see the financial market as an island where there's been a party going on, where you can drink without getting drunk, where you can eat without putting on weight, and there's an endless party. Once in a while, there's a ferry coming from the island with provisions and new goods, but now that has stopped, and that's what's going on. Basically, we don't have the infrastructure and the supply elasticity to pay for the free generational bet that the politician and the central banks are doing, fighting inequality, moving to a green transformation, and overall building out the infrastructure. So it is different in the sense that it's the first time since the 1970s. But as you are referring to the title of our Outlook, of course, you know it's with a tongue in cheek. Of course, nothing has changed because reality is negative real rates. It's the game. And negative real rates means that we have no productivity in the future, no growth.
Yeah, but Steen, there are islands and there are islands. I mean, there's Magaluf or there's Battle Royale. I mean, which one are we in here? Because a lot of people could get taken out at the wrong price if we do see a firming up of this technical pullback.
I think a lot of people will be taken out because the game, as you alluded to, you and Karen in your talk just now, is that the convexity, or put very differently, a small move in interest rate can create an outsized move in terms of equity, because simply you have a number of stocks that's been carried forward by this negative real rates. And as we normalize, as we go into a relatively tighter monetary condition, of course, the convexity comes back to haunt you. And that's what we've seen in the technology companies. That's what we see generally. And then on top of that, you have the geopolitical factors, which is that China is clamping down, tightening liquidity day by day. This morning announcing that they are not going to allow commodity lending at all from the Chinese banks. So constantly we see this tightening, and we see that convexity, i.e. we see very big moves from very small move in interest rates because people simply underestimated it, Jeff. And I think it goes to the reason you alluded to before as well, which is that a number of people in the market today, I mean, you and I are probably the only two geezers around who's been around for a few crises these days.
Yeah, you're talking about the 70s in a lot of your commentary, Steen. I think a lot of people really struggle to remember what happened back then. We've been talking about where is that inflation, which rock do we look under for so many years now in Europe. But you also point out about Europe being on the cusp of an energy shock. Steen, we keep on seeing problems at the pump. OPEC and its allies are not doing more to relieve pressure either. What do you think this means for any sort of equivalent of an oil price shock in Europe?
Well, we're already in an energy crisis. I notice most people talk about a potential energy crisis. We are in an energy crisis, and it's courtesy 70% of central bank and 30% by inefficient politicians, because simply what the overall framework of monetary conditions has done over the last 10 years is to put excess return on capital and below par return on investment. So simply we have created a situation which is unsustainable. But what's interesting from the market's perspective is that the ability to give more liquidity has disappeared, because in academic circles, even in central bank circles now, they do realize that providing more liquidity will only increase the inequality and the bottlenecks. If you provide more fiscal boost into an environment of too small physical world relatively to the demand, again, you're going to increase it. So whether you provide liquidity or you provide additional fiscal stimulus, which for the record will come in the space of the next month or two to, of course, to mitigate some of the fallout that we've seen in consumers and lower K population in terms of the cost of energy and food. So we are in a catch-22 where we compete against each other to get resources. Europe has decided, in particularly Germany, to do a model where they have to be dependent on what side of the bed that Putin wakes up in order to get the prices down.